Silver futures are screaming breakout to $84.57, but spot silver is in free fall. Right now, we have a 60-day low, strong sell signals on every time frame. Yet the industrial PMI just printed a massive expansion. That is a trap, and it is going to snap hard. There is one danger zone and one hidden opportunity today. I'll show you both. Stay until the end. I'm giving out 3 exact entry and exit levels you can use right now, including a counter trend play that could catch the reversal of the yield MY session bias is aggressively bearish, but with a trap wire ready to flip if we get a single closing level. The trend is strong sell on the daily, the 5-hour, and the 1-hour chart. Price is cascading below every major moving average except the 200-day, which is miles lower at 63.85. That means there is nothing to catch this knife until the 72.20 support. However, if the market is pricing in that PMI, we could be witnessing a spring-loaded reversal. Write this number down. $72.21. That is the line in the sand. If silver breaks below 72.21, the whole structure shifts, and we are heading to 70.20, maybe 68. If we hold above it and reclaim the 50-day moving average at 76.70, the bearish thesis is dead, and the $84 breakout is in play. I want you to watch 76.70 on a daily close. That is your invalidation. Let's walk the chart from the top down because the disconnect between the technicals and the fundamental catalyst is a textbook trap. On the weekly time frame, we are neutral, but look closer. We've been in a wide range between 68 and 84 for months. Last week, silver tried to push toward the 81 resistance and failed, forming a long upper wick. This week, we've sliced through the 79 pivot and the 78.20 area like butter. The weekly moving averages are flattening out. The MA20 on the weekly sits at 78.16. We are now well below it. This is the first serious crack in the weekly structure. The MACD on the weekly is curling over from a neutral zone, losing momentum, and that's a whisper that the multi-month range is resolving to the downside. But here's what most traders miss. The 200-week moving average is still rising from 63.85, and that is the ultimate backstop. If we ever get down there, it will be a generational buy. But between here and there, it's a minefield. Drop to the daily. This is where the strong sell signal is screaming. Price closed below the 76.70 50-day MA 3 days ago and hasn't looked back. Today we are at 74.44, collapsing below the 75 handle. The MA5 is at 80.81, the MA10 at 81.39. Both are above and sloping down sharply, creating a bearish fan. The MA20 at 78.16 is also rolling over. The 100-day MA is at 80.82. Right near the breakdown zone, reinforcing overhead supply. The only support from the moving averages is the 200-day at 63.85, which is too far to matter right now. This is a wide open space for price to fall. The RSI is at 43 and dropping, no divergence, no oversold signal yet, meaning there's fuel for more downside. The daily MACD is printing 1.07. Still positive but contracting fast. The histogram bars are shrinking, and a bearish crossover is imminent. This is exhaustion you can feel. On the 4-hour chart, the moving average alignment is textbook bear. The 20 period sits around 75.30 and is a falling knife. The 60 period at 76.10 is sloping down, and the 200 period on the 4-hour is up near 79, acting as the ceiling. Every rally gets sold. The MACD on the 4-hour is below zero and accelerating. No bullish divergence yet. On the 1-hour, price is making lower lows and lower highs, with the 20 period acting as dynamic resistance at 74.85, and the 60 period at 75.15. The RSI on the 1-hour is bouncing around 35, but there is no base forming. This is a grinding, relentless sell. The support structure. We have a critical demand zone at 72.21, which is the weekly swing low from the last quarter and the bottom of a monthly value area. Below that, 70.20 is the next structural level, then a liquidity void down to 68. Resistance is stacked. The first intraday resistance is 74.80, then 75.50 the 4-hour MA, then 76.70 the daily 50, then the massive 79.34 zone. The bullish PMI signal from the analysis article is screaming a breakout to 84.57, which lines up perfectly with the major weekly resistance at 84 and the zone from the spring highs. So the chart is telling us one thing: bears are in control until 72.20, but a close above 76.70 would trap all the late shorts and ignite a violent rally to 81 and 84. That's the trap. That is the opportunity. The next signal changes everything. Yesterday's Silverco mining acquisition news is noise, but the real driver is the VC PMI signal. The manufacturing PMI data from the venture capital side, an early gauge of industrial activity, printed a sharp expansion above 55, signaling that factories are ramping up. Silver is the industrial heartbeat. Over half of its demand comes from electronics, solar panels, and manufacturing. When PMI surges, silver tends to rip higher with a lag. That's why futures are targeting 84.57. The problem is spot market is still pricing in a recession fear and a stronger dollar. This is the classic spot futures divergence that either resolves with spot catching up violently, or with futures collapsing. The PMI data is forward-looking, so the next ISM manufacturing print and China's Caixin PMI will be critical. If they confirm, the industrial bid returns. If they disappoint, silver gets a one-way ticket to 68. Let's cross-check with gold. Gold is the fear architect, and it's holding near 1980. If gold were breaking down hard, I'd say silver is doomed. But gold is resilient, which hints that the precious metal bid isn't dead. Silver is underperforming. The gold-silver ratio is blowing out to its widest in months. That's a classic recessionary setup. However, when that ratio mean reverts, silver explodes. So watch gold's 1980 support. If that breaks, silver's 72 support is toast. But if gold holds and starts moving above 2000, the silver trap will spring. The dollar index is the villain. The DXY is pressing against the 105 resistance level. A breakout above 105 would be a silver bulldozer, sending it through 72 straight to 68. But if the DXY gets rejected and rolls over, that's the green light for the PMI trade. Also watch the S&P 500 risk appetite. Bitcoin's correlation to equities is high, and silver often moves with the industrial reflation trade. If the S&P rallies on manufacturing optimism, silver could ride that risk-on wave. Right now, the S&P is hovering near key gamma levels, and any strength there supports the industrial thesis. I want you to comment the word industrial if you think silver is bottoming here, or recession if you think it's breaking down. Let's gauge the room. My 1 to 2 week directional lean is this. I am bearish below 76.70, targeting 72.20 and 70.20. But I am ready to reverse long aggressively if we close above 76.70 on a daily basis. The event that invalidates this bearish lean is a daily close above the 50-day MA with a bullish PMI follow-through. Until then, I sell rallies. But I'm not going to be a stubborn bear. The PMI trap is real, and I will not be caught short when the reversal rips. Most people will skip this section, but this is where money is made. Keep watching. I'm giving you 3 strategies, each with exact triggers, stops, and targets. Strategy 1. The sniper. Conservative. This is for those who want high probability and are patient. The setup. Wait for a pullback into the dynamic resistance of the 4-hour MA20, which today sits at 75.30 but is declining, so by tomorrow's session it will be around 75.10. I want to see price rally into the 75.10 to 75.50 zone and show a clear rejection, a bearish engulfing candle on the 30-minute chart or a long upper wick with MACD divergence on the 15-minute. Trigger entry on a break below the rejection candle's low. Stop loss at 76.75, just above the daily 50 MA and yesterday's high. That's a stop of about $1.20. Target 1 is the 72.20 support level, giving a risk-reward of roughly 2.5 to 1. Target 2 is 70.20, extending risk-reward to 3.8 to 1. If price closes above 76.75, the setup is void. This plays the continuation of the strong sell with a protected entry strategy too, the active trader, standard. This is for those who want to catch the breakdown momentum as it happens. The entry condition, a clean 30-minute close below 73.70, which is the overnight swing low and a recent microstructure level. That signals acceleration. Stop loss sits at 74.45, just above the current intraday resistance and the top of the breakdown candle. That's a 75-cent stop. Target 1 is 72.25, just above the major support, for a risk-reward of 1.9 to 1. Target 2 is 70.20, giving 3.4 to 1. Once target 1 is hit, move stop to break even and trail by 30 cents to lock in profit on the way down. Invalidation. If price spikes back above 74.80 and stays there, the breakdown failed. Before I give you the high-risk aggressor play, let's see how aligned we are. Type your silver range for tomorrow in the comments. Give me your high and low. I'm reading them. I want to see who's on the right side of this trap. Strategy 3, the aggressor, high risk. This is for the brave. We are fading the bearish momentum on a potential false breakdown and riding the PMI reversal. The setup, if silver dips below 72.20, but fails to close below on the 4-hour candle, and we see a massive bullish engulfing or a long-tailed pin bar with RSI divergence on the 1-hour, you enter long. Exact trigger, a 4-hour close back above 72.50, confirming the false break and liquidity grab. Stop loss goes at 71.50, just below the psychological 72 and the zone where stops get hunted. That's a $1 stop. Target 1 is 74.50, the current breakdown origin, for a 2 to 1 reward. Target 2 is 76.70, the daily 50 MA, for a 4.4 to 1 reward. If this works, you catch the $84 surge early. But I must warn you, this is only for those who know how to lose small and manage risk aggressively. It is a counter-trend trade against strong sell signals and a strengthening dollar narrative, so size accordingly and be ready to be wrong fast. Never risk more than 1 to 2% per trade. No positions through high-impact news like ISM or CPI. Stops are non-negotiable. The most critical level for the next session is 72.21. A break below opens the trapdoor to 70.20 and 68. A hold and bounce, confirmed by a recovery above 76.70, sets up the PMI breakout to 81 and 84. Tomorrow I'm watching the dollar index reaction at 105 and gold's hold of 1980. If gold cracks and the dollar surges, silver will test the abyss. If they reverse, the industrial bid will blindside the late shorts. I'll be back with the full breakdown on Bitcoin and the S&P divergence. That video is live now. Check the end screen. Smash like if this analysis gave you a clear plan. Subscribe and hit the bell for daily silver and macro insights. I'll see you in the next one.